deal here. 750. You're still going to raise that, over the next couple of years and start putting that money to work when?
Yeah, hopefully much sooner, but probably over the next couple of years. We may start putting money to work pretty soon, actually. We have a lot of interest. We have a lot of deal flow, a lot of relationships, and I think teams and leagues are seeing that we bring a lot of value to some of these organizations to help them as they think about transitioning from Sports 1.0 to Sports 2.0.
Now, I know you can't talk a whole lot about the fundraising here, but when I saw the 750 million, I kind of thought to myself, that kind of seems low. I mean, there's so much demand in this space. I mean, there's just so much money coming in, and I'm wondering, I don't want to get ahead of you here, but I'm wondering if maybe we're going to have you on in 6 months and that number is going to be a lot higher.
Hey, I'm hoping so. Mm-hmm. But as a first-time fund in this space, 750 is a reasonable amount to deploy capital into North American sports franchises. Mm-hmm. But based on the demand that we're seeing, we do think it will probably be a little larger than that. But I think it's a respectable amount to enter the space.
All right, and you already, of course, have been involved with the NFL's Atlanta Falcons. We should point out this fund that you're starting, it's basically agnostic with regards to the sports league. NBA, MLB, NFL, anything else in there?
Yeah, I would say North American sports, and there's such big opportunities in North American sports right now, like you were just talking about. But as these leagues continue to mature, as media rights continue to increase, as they continue to build new stadiums and own all the real estate around the stadium, basically becoming media companies themselves. So sophisticated capital, investors want folks who have skin in the game, who have been owners and operators to help Sherpa them into this asset class. Mm-hmm. And one of the things that's important from an investor standpoint is non-correlated to the equity market. So as a former venture capitalist and tech guy, I needed to diversify out of tech myself. So I started redeploying my assets into this space about 5 years ago. And I think you're starting to see that trend a lot with family offices and institutions.
With the involvement now of more private capital in this space, now that some of these leagues have loosened the strings on that and you have more investor interest, is that going to create distortions when it comes to valuations? I pointed out the $6.1 billion deal for the Celtics, which would be the biggest deal for a sports franchise ever, at least in North America. But I should point out, there was actually a story earlier today that apparently the San Francisco 49ers are in play at a valuation of more than $8 billion if that were actually to go through.
That's right. That's right. On the cover, it appears that more private equity coming in is going to drive the prices up. But if you peel back the layers, you'll see private equity is not allowed to own majority stakes in most of these leagues, just minority stakes. They're all capped at small percentages that private equity can own. So the majority stakes and the control owners of these teams are still families. They're still individuals. They set the price because they're buying the majority of the team. Private equity comes in as a partner to help provide liquidity to shareholders and owners who've been around for a while, guys that are thinking about succession planning, guys that need cash in order to build new stadiums, and all of the other reasons that people want liquidity when they don't have IPOs or M&A. So private equity becomes a great strategic partner to shareholders and to the ecosystem.
So what are the rules like right now? Because when we talk about, the NFL allowing private equity, and I know on a high level, right, the idea is that you can't really have, more than 6 franchises. Is that as a majority investor or as a minority investor?
Yeah, so we're only talking about minority investors when we're talking about private equity firms. So there are some things called league beneficial owner rules. Every league has different rules, but it used to be uncapped. You can have 50, 60 owners of a professional sports team in North America, 30, 40 years ago. Mm-hmm. Today, they tend to cap it at, maybe 24 owners. So what happens is as valuations get higher and higher, and people who got in at $200 million and it's worth $3 or $4 billion now, sometimes they want to take some chips off the table. And they can't sell to another owner because that owner is like, hey, I was in at $200 million with you. I'm not going to pay $3 billion. And if they sell to someone else, it trips over those league beneficial owner rules. So private equity comes in and they're largely exempt from those rules. Private equity doesn't count as a limited partner or as an owner, so they can come in and relieve that pressure on the cap table and start helping with liquidity programs for some of these owners that want liquidity.
For your fund, though, I mean, generally you're targeting 5% or less? Is that the general idea in terms of ownership stakes, or is there no?
Yeah.
Yeah. Okay.
Yeah. So we're working right in the guidelines that each of the leagues in North America has already set, and it's really small stakes, right? You're talking about 1 to 5% stakes in teams. You'll have multiple private equity firms investing in the same team, but you'll never have, won't say never, it's unlikely that you'll have private equity firms buying a majority of a team and controlling the entire. These are family run, individually run teams and leagues.
I think it's kind of interesting too, Rashaun. We've talked a lot about the business of sports and all the investment coming into sports, but often that conversation has been about more, I guess, newer sports, if you will. You know, you're talking volleyball, lacrosse, pickleball, things that haven't traditionally been prominent in the U.S. zeitgeist. You're going all in for the granddaddies of U.S. sports here. And I do wonder, though, because, I don't know what to call this. Is it an early stage investing? I don't know if it's late stage. I don't know what it is. It's behemoth investing. And I do wonder if that carries any sort of risk that you've had to sort of talk about.
It absolutely does, and you're spot on. I'll give you the best comparison I can give you in tech. That's the ecosystem I've been in the last decade. So there's early stage, growth stage, and then late stage risk. Early stage, an idea, very little revenue, very little traction, tons of upside, high risk. That stuff takes 10 to 15 years to make money. Only 1 out of 10 make it, right? Think of the early stage sports leagues that you're seeing out there. They're popping up every day. In fact, once we made this announcement on this new fund, I got 50 emails from leagues that I never even heard of. Now, then you have growth stage, and those are teams and leagues that have been around for a while. Maybe they're not profitable yet. They're still growing really fast. They're close to getting to that mature level, like late stage, but they're on their way, right? I would consider WNBA, I would consider Major League Soccer great opportunities, but still sometimes you have to do a capital call. They have to fund their losses with raising more capital and sometimes diluting shareholders. Now, at the top of the food chain are the late stage or the mature leagues, the basketball, football, baseballs, and they're largely profitable. They very rarely do capital call. There are a few exceptions. They want to win the championship and just start spending a bunch of money. But for the most part, they're stable. They've reserved money in case of a COVID or a player strike, right? And you're not really getting capital calls on them, but stable, expensive assets with a long-term stream of cash flow. Those are the safer late-stage assets.
What makes, in your view, a good investment in a sports franchise or a sports team? Like, what are you looking for? Do they need to be, I guess, winners, if you will? You're going to go after the Philadelphia Eagles, or, can you maybe go we started off talking about Mark Lazary. He bought the Bucks when it was an awful team, let's just say it. And of course, he rode that wave to, a team that, basically became championship contenders.
Right. So there are fundamentals and then there are technicals. So what you see oftentimes with sports, it crosses over to the passion play, and folks were willing to pay whatever price that they need to pay in order to win, the opportunity. Those are more technicals, right? I want this. I'm from Boston. I want to own this team. This is the only basketball team in Boston, right? So the technicals go really strong for local Boston billionaires who want to own that team. But the fundamentals, the most important part of actual tech of sports teams investing is having the strategy that's appropriate for you as an investor. So again, if you're looking at early stage leagues and teams and only 1 out of 10 make it, it's your job to find 10 to 20 of the fastest growing, best teams and leagues in that space, and then try to get the best price you can on all 10 or 20, knowing only 1 out of 10 make it. If you're only going to do 3 investments and only 1 out of 10 make it, that's not a good strategy. So you're guaranteed to lose money there, right? But for the late stage, when you're looking at the big 3, you're looking at these profitable teams, what you really want to do is look at the management team, you look at the owners, you look at the market that it's in, the percentage of revenue that's coming from media, the percentage that's coming from league and local revenue, and you see what their plan is to grow their revenue in the ways that they can control, which is largely local revenue. Here are the 3 things I would look at if I had to summarize for you. Number 1, are they operating under the assumption that they're just relying on the league for most of their revenue and they're not looking for, local revenue growth opportunities? Number 2, if they are looking at local revenue growth opportunities, building and owning the stadium, renting the stadium out for concerts, whether or not they have pricing power to increase prices, using predictive analytics, there are a bunch of things you can look at to drive more revenue locally. Here in Atlanta, just look at the Battery, right? Look at what the Braves are doing, hotels, office space. This is all flowing through. Chicago Cubs are doing something similar, buying up all the real estate around. There are teams that don't even own their stadium, so they're largely capped. And then number 3, are they really looking at themselves as the future of sports, taking this content that they're creating and monetizing it in additional